this week's episode of Coinscrum Markets. I'm Nisa. Coming up, Guilhem Chaumont returns to review the options markets in crypto RFQ. Ziglu CEO Mark Hipperson joins me to discuss their recent authorization by the UK's FCA. ExoAlpha's David Lifshitz and Flovtec's Anton Golub talk to us about how to prudently construct automated trading strategies for digital assets. First, a look at this week's blockchain industry news. SWIFT, the global financial transaction network, unexpectedly came out in defense of cryptocurrencies in a report they released this week, countering the long-standing argument that Bitcoin and other digital assets are only used to launder money. The authors of the report found that the role that cryptocurrencies play has been overstated, with fiat still being the currency of choice for those washing their funds. Leading trading infrastructure and key management firm Fireblocks has announced a partnership with clearing technology provider Xmargin to utilize their zero knowledge proof technology to enable institutional trading firms to cross-margin and bilaterally trade derivatives without compromising security or privacy. With the DeFi movement and headlines going hand in hand in recent weeks, this week saw accusations of an exit scam being thrown at the founders of the SushiSwap protocol. Although over $1 billion remains locked in smart contracts, the claims were made after the founder, known as Chief Nomi, withdrew $12 million from the liquidity pool, leaving some users out of pocket. Regulators are circling DeFi, and leading crypto legal expert Preston Byrne also stepped into the fray, arguing that victims should be in a position to file a lawsuit. Nation-state interest in Bitcoin was in the news this week when the Digital Development Minister of Kazakhstan announced they'd be investing $700 million into the Bitcoin mining sector. The country has already become a major base for operators looking to access cheap energy in recent years, attracting 13 mining farms and around $190 million in investment to date. And finally, while Bitcoin was breaking into the top 6 global currencies last week, measured in circulating supply in US dollar terms, Bank of England Governor Andrew Bailey reserved judgment in a speech he made about the evolution and digitization of money and cash. Although he gave short shrift to Bitcoin itself, likening it to nothing more than a collectible, he was far more positive about the idea of blockchain or DLT-based stablecoins. That's the news this week. Don't forget to click and subscribe to our channel for more updates. Next up, Crypto RFQ.
Thanks, Nisa. I'm joined today by Guilhem Chaumont from FlowDesk. Hey, Guilhem, thanks so much for joining us today.
Thank you so much for having me.
No, it's great. It's great to have you back. So we're going to take a little dive into the option markets today. Am I right?
Yes, completely.
Brilliant. Let's kick off with open interest around BTC. What's been happening in the markets this week?
Yes, so it's really a key metrics to track what's happening on the derivative sides. And basically, we've got a lot of excitement in the past months because open interest on options completely skyrocketed, notably on CME, which is a key for institutional investors. Mm-hmm. And we were definitely interested, to track that in the summer. And what we can say is that these volumes have been relatively steady, but the momentum is not getting as traction as much as we could expect. We are more or less in the 1.8 billion USD area of open interest, which corresponds to 1% of the total market cap for Bitcoin. So that's pretty good. But compared to what we had in the past months, we could have expected more. And on the CME side, the volumes completely exploded by a factor of 10 during May. And we could expect similarly, these volumes to keep on going. And unfortunately, they are losing a bit of space. And right now, CME is only a few % of Deribit's market share in options.
What do you think is impacting that? What are the indicators that you're looking at that are giving you some insight into why?
It's a bit hard to tell. I mean, in my opinion, we've seen, especially during the summer, and that could be completely caused by the summer, a lack of interest from institutionals in Bitcoins. I mean, at least not as much as we could have wanted to, as we could have expected, especially since in May and June it was quite active. So I think overall the derivatives and particularly the options market is just impacted in a similar manner.
Mm-hmm.
But I'm relatively confident for the remaining part of the year.
Okay. So let's talk about implied volatility. So I know you sent me a chart looking at BTC ATM. What are we looking at here?
So I think this one is very, very interesting because what we can see, particularly after the 31st of August, is that the implied volatility on the options has started, to significantly increase.
Yeah.
But the price itself, was still in the 12K area without, significant moves. So that definitely tells that there has been some anticipation of what has happened during the last 72 hours, the move from 12K to 10K. A bit unsure and hard to explain why, but clearly some people wanted to bet on the volatility, and they did that right before the crash.
Okay. And then, our next chart's looking at IV versus RV. So the, implied versus the realized. What are we looking at here?
So here it's a bit of the same picture. What we can see is that the implied volatility has increased a lot prior to the crash at the end of August, while the realized volatility was extremely steady. So the spread between the two is clearly an indicator of what people are betting in the markets. And we can see that definitely there were some people betting on whether this is an upside or a downside right before the crash.
Yeah, indeed. Okay, so total ETH options open interest. ETH has had an interesting few weeks, and looking at this chart, it's reflective of a lot of increased interest.
Yeah. So I mean, we've not talked a lot about Ethereum options because that market was not that significant.
Sure.
But obviously, because of DeFi, there has been a growing interest for Ethereum in general, and so that's really why today I wanted to say a few words, because basically what we are seeing since 2 months is a similar pattern as what we have seen in the Bitcoin options market back in May. Huge growing numbers, and if you look at the figures right now, we are more or less around 1%. Of the total market cap for Ethereum. So, I mean, what we can say is that now the options market on the Ethereum side is definitely comparable in terms of volume to the Bitcoin market.
Yeah.
So I think that's very positive, because as there is also growing interest because of DeFi for Ethereum, we need hedging products, we need speculative products, and options are definitely one of them. And the increase in volumes and liquidity is going to help us do our business, basically.
Indeed. So let's compare BTC to ETH, looking at the implied volatility on our next chart here.
Yeah, so for this final chart, just wanted to say, very quick words on the fact that obviously the Ethereum implied volatility curve is much higher than the BTC one. That's caused obviously by the volatility itself, but of course because of the strong retracement we have had in the Ethereum in the past days, caused by the exit of liquidity from Uniswap notably. So I mean, I think here there is not so many surprise. Just looking at the regular option curves with deep out of the money puts being extremely and highly priced. That's the price, of course, for the risk and for the hedging. But that's something that we are really closely monitor. Because it will tell us a lot about what can happen in the next weeks, and whether or not the uptrend will continue. So yeah, some interesting metrics to track.
Interesting. So I'll put you on the spot. What do you predict in the next week or two? Where are these markets trending? Or do we not know? I mean, hopefully the DeFi thing just came out of nowhere, right?
Yeah, the DeFi thing came out of nowhere, but clearly, what I'm going to look at is the Ethereum market, because I think Ethereum market is going to be a driver for whole markets much more than it used to be, and that's really what we see right now with Bitcoin. Not much retracing, but Ethereum having up to 40% dump. And I'm going to look at the fundamentals. And actually, I was really surprised to see that if you look at the locked value in DeFi it has gone up almost to the highest levels. The amount that we have in Uniswap, I think it's close to 8 billion in total now. So I think the fundamentals are relatively good on this side. So on my end, I'm expecting to stay in these levels for a few weeks, reintegration of the $400 level for Ethereum. But I mean, at this point, we will see, because anything can happen. We will see whether or not we have interesting new projects coming in DeFi, because we need them to fuel this market, obviously. Right now, we have not seen so many, to be honest. So yeah, I'm really curious about the fundamentals and which new projects are going to come in the game.
Yeah, it's so funny to hear you say that, Guilhem, when I was speaking to somebody earlier in the week, and we were going over, what had happened in the past week in, the ETH and DeFi space, and the positions that some people had taken. And my husband is an ex-trader, and he looked at me and he said, does nobody look at the fundamentals? And I was like, well, in crypto, I don't know. Do we have fundamentals? But it's funny. You just used the term. So somebody is.
Yeah, we will have to look at the fundamentals at some point.
Indeed. Thank you so much for joining us again today. We'll have you back in a couple weeks and take a look back and see what happened.
Thank you very much.
You're welcome. Fantastic. Back to you, Nisa.
With only a few traditional banks engaging with crypto firms, challengers are stepping in to fill the gap. Founded by banking veterans in the UK, Ziglu has just been authorized by the FCA as an e-money institution, expediting their plans for expansion. I spoke to their CEO, Mark Hipperson, to find out more about their plans. Welcome, Mark. So happy to be with you today. Thanks for joining us.
Oh, you're very welcome. Good to be here.
You and your founding team have gained significant experience both working at traditional banks and then building challenger banks designed to disrupt traditional banks. So tell us a little bit about that background.
I founded Starling Bank as a CTO of Starling Bank, and as you might be aware, it's one of the original challenger banks. We were the first bank, I believe, to build our banking platform in the cloud from scratch and host it and run production in the cloud. And then just after us, the guys at Monzo came along and Revolut or thereabouts as well. So just before us, there was Atom and there was Tandem doing their thing. So it was a really vibrant time in terms of that sort of launch phase of 2014, 2015 when we founded it, as a consequence of all the changes that occurred in Europe at the time in terms of the European Banking Authority empowering the FCA over here to allow people to be able to fast pass their banking. So we took advantage of that.
And congratulations, you've just received your e-money institution license.
We have.
From the FCA. So now what does this enable you to do?
So being an e-money company means that you're regulated to safeguard customers' money. So we have that in a separate safeguarding account, which is a good thing for customers, but it also enables us to be able to deliver some I guess, current account banking type features that traditionally only banks could provide. Anyone, anywhere. So if you're a Ziglu customer, you can pay each other in fiat currency, traditional currency, or cryptocurrency. But also you can use UK faster payments as well. So you can make a payment to any bank account in the UK. And we've got a whole raft of other payments coming in due course in terms of European payments and SWIFT and those things in due course. But also it enables us to be able to launch cards as well. And cards is obviously we've got a MasterCard, a Ziglu MasterCard debit card that we're testing with right now around London and the UK. Just making sure it all works before we start releasing it out to our customers, and our e-money license enables us to be able to do that as well.
So what doesn't it allow you to do versus gaining a full challenger banking license?
Right, well, we deliberately went down this route, if I'm honest with you, because the flexibility it affords in being able to do crypto, it's very difficult to do that if you're a bank. And it enables us to be able to manage our capital adequacy a little differently, so we don't have to put quite as much money with the Bank of England to be able to do the things that we do. And the banking licenses, I guess, the toughest and most challenging thing to achieve in the UK, and we're very proud to have done that at Starling Bank as quickly as we did. But I think there's one or two companies out there that have proven that you can be very successful and do many of the things, if not all the things, that one of the challenger banks can do without having that license. So we've gone down that route as well, and we feel it gives us lots of the flexibility that we need to be able to offer the services that we're offering, not only now but in the future. And it also enables us to be able to take advantage of open banking and the Second Payment Services Directive to provide open APIs, which enable customers to be able to have access to the same sort of things that you might have access to with their bank. So credit facilities and interest on accounts and insurance and all the type of things that banks may offer, we can offer through open banking and PSD2, and they're some of the things that we might be doing in the future.
Is there anything that's prevented other challenger banks from making the move into digital assets?
If you're a challenger bank, you would not find it very easy to move into crypto. It's something. It's not officially banned in the UK, but to all intents and purposes, it is. There's two pieces of legislation that are important to enable us to be able to do what we're doing. It's the e-money license, but also the fifth money laundering directive registration process, which is a process to ensure that we are dealing with crypto in the right sort of way. So what that means is there's a very, very high barrier now to say that we want to make sure in the UK that we understand where cryptocurrencies come from. So as we're dealing with cryptocurrencies, one of our services, we need to show that our anti-money laundering, our compliance, our risk and general overall governance of our business meets the standards expected by the FCA, and they're very, very high standards, as you can imagine. So that's a really important part of what we've been through as well, and we've been registered for. And I believe there's only 3 companies in the UK that have gone through that process right now, and we're one of them. So we're very proud to have that badge and have achieved that registration, and that allows us to be able to both offer current account type services like a challenger does, but also offer crypto services as well.
So you have been around 2 years and you elected to build an entire cloud banking platform from scratch when others might have licensed it from a third-party vendor. Why did you decide to do that?
Well, we're a tech company first and foremost with an e-money license. So as a tech company, you need to own your own tech. It's something that I passionately believe in, having been a CTO in the past. And once you own your core, then you can integrate with best-of-breed third parties to do ancillary services, to do things that are important to the overall proposition. But you have to own the heart of your business as far as I'm concerned. And if you look at some of the world's biggest and most successful fintech challenges, they all do that. So, you know, we're very pleased and proud that we've been able to do that. There's very few companies in the world that have done what we've done. But it does enable us now to be able to own our IP, own our release schedules. If we want something done, we can get it out within a release 2 or 3 weeks or so, and we can change and we can adapt and we can evolve really, really quickly. And it allows us to be able to control our unit costs. We're not paying a third party for running on their infrastructure. So it's something that is very important to me. Now, there are companies out there that might choose to use someone else's tech and banking ledger. And you know, some of those banking ledger companies are pretty damn good. But we went through the route of saying that it's important, certainly for our future scaling of the business. You know, it's all in our business is all in Google Cloud. It's all highly scalable, highly resilient, highly redundant, as you might imagine. Which means that, you know, we've tested and scaled it through testing to many hundreds of thousands and millions of users actually.
How long before digital assets appear on the statements of everyone's bank accounts?
Well, they appear on ours today. So if you have a Ziglu app, your currency transactions, no matter what currency they're in, appear in your app, and that's the way that we do it. So you have your GBP, your Bitcoin, your Ether, and they're all there. And every time you do a transaction, no matter what currency it is, whether it's on a payment or you're sending some money to a friend, or you're using your card, all those transactions appear chronologically. You can sort them and filter them, of course, but they're in our app now. Now, will the other guys catch up? Yeah, I'd imagine they will do in due course, those that offer crypto. But banking is going to be tough, as I said earlier, whether they will be allowed to get into it or they'll choose to get into it. We've all heard the resistance of the banks over the years, from Goldman's and JPMC, saying never, we won't touch it, to actually we realise it's here to stay now. We realise it's not a problem, and they're embracing it now. Whether they're a big major bank or a big company such as Facebook getting into it with Libra, or governments realising it's here to stay and it's going mainstream, it's inevitable that more will offer it as part of their part of the facilities they offer customers. And clearly in America, I think they're slightly leading us in Europe in that regard. In banking and bringing it involved and holding those crypto assets for us. But as I said, we've been doing it for a while now, and our customers love it.
Well, great. Thank you so much for being with us today. Thanks for moving the industry forward, and congratulations again.
Thank you. It's nice talking to you. Thanks very much.
Attracted by high volatility and a fragmented market, an ever-growing cohort of quantitative traders and funds have migrated from traditional markets into crypto in recent years. But how do trading strategies in crypto compare with other markets, and what additional risks need to be factored in? I spoke to ExoAlpha's David Lifshitz and Flovtec's Anton Golub this week to tap into their findings. I'm delighted to be joined today by David Lifshitz and Anton Golub. Welcome, gentlemen. How are you today?
Doing well, thank you, Nisa.
Yeah, doing very well from the virtual Zurich in the back, so doing awesome.
So when looking at structuring a fund for traditional assets, what are the key factors and metrics you look at before you begin, and how do they migrate to digital assets? David?
Actually, digital assets are an interesting asset class because, contrary to traditional assets, they are trading on a continuous basis, 24/7. There are no gaps, no overnight gaps or no weekend gaps, which is a lot on the risk management side. So that's basically a key factor to take into account when setting up basically trading strategies for these specific assets. So, and I know, Anton, that from the trading and execution point of view, you have a lot to say about the crypto as well. So I'll let it to you now.
Yeah. So thanks very much. I'll kind of try to separate the questions that we looked at into three categories. Kind of the first one is the strategy and the infrastructure. The second one is how do you actually set up a vehicle that everything works? And the third part is how can our investors understand what we offer to them, And now kind of moving to the first part, as David mentioned, it's 24/7. I came actually from the ethics background where things were 24/5, So definitely a lot more opportunities that we can capture. But speaking and thinking about the infrastructure and the connectivities that the exchanges have in the crypto or digital asset space, this is still inadequate and not at the level what we would see, for instance, in the FX or the equity markets, where we're talking about fixed connectivity, where we're talking about low latency matching engines, trading systems. That's not the case what's happening at the moment in the crypto space, the digital asset space. Therefore, the strategies themselves cannot capture the opportunities that we would look at the millisecond basis in the FX space or the equity space. So this is kind of the first challenge. Infrastructure and connectivity, that's not the level we would expect. The second part is talking about the structures. I can tell you the pain that we had when we had to explain to those trading venues what is it we're onboarding with them. That we tell them, look, we're onboarding a Cayman fund with you, or we're onboarding actually a structured product out of Guernsey with you. They just don't have that experience of onboarding this kind of products. And many times it's a back and forth discussions, what is it we're trying to do? Why are we not trading on our own account? And why are we not like the typical retail trader they might see, And then the third thing is, if I have to explain, is our investors, How can investor understand what just David mentioned is that crypto world is 24/7, And maybe they have their colleagues, they're on a boat somewhere in the Lake of Zurich, and on Sunday, their friends tell them, hey, did you see crypto tanked 30%? And they would tell them, what do you mean tanked? It's Sunday, markets are closed. And they would tell them, no, they're not closed, they're open, and it's moving all over the place, So I'm illustrating certain problems, but that's the kind of education that many times we have to do with investors to understand what they're getting themselves into, you know?
So what strategies have been easiest or most obvious to apply in crypto assets?
From my point of view, essentially mid-frequency trading strategies have been the easiest to adapt, because as Anton said, the infrastructure, the market infrastructure is not ready yet for high-frequency trading. And in terms of behavior of the crypto, there are still kind of illiquid versus traditional assets. So the trends tend to last longer than traditional assets. So all the, I would say, trend following or mean reverting strategies tend to do well in that environment for that asset class at the stage that they are right now. But just a few years ago, when they were even less liquid, it was even harder for them to trade them. But now with more liquid products, options, and futures on these assets, it makes basically it easier to apply, we say, essentially CTAs kind of trading strategies, and also market neutral market making strategies are basically developing right now. But we are not yet at the point where what we can find or what we can do with the traditional assets, especially in terms of execution and ultra high frequency execution.
Yeah. I would just second, you know, here what David mentioned, that it's mid-frequency, and also I would actually add that we found it, given our experience on the fully automated side, that maybe discretionary strategies are a bit more easier to deploy because of the fact that the connectivity and the infrastructure is sometimes a challenge with the trading venues. So I really second everything that David said in that regards. Yeah.
So speaking of risk management, how do you deal with potentially fake volumes on exchanges?
Yeah, so I can kind of share our experience with regards to fake or ghost volume, how we see it. And indeed, I mean, this has been somewhat of an issue actually with the digital asset space, that there's this ongoing team and discussion around there's a lot of fake volume or just non-existent one, and the volume numbers that you see being reported are not representative of what's actually happening. So kind of have to actually relate to it from a investment manager perspective. Is actually those fake volume is actually, you can identify it quite easily, and then you can shy away from the exchanges that do this kind of practice. But we always kind of wonder, how does it reflect actually when it really matters, you know? And I'm talking about here highly volatile situations, you know, where the markets move a lot. And then the question is like, from all this fake volume that, you know, all of a sudden isn't there, you can't do anything with it. Then the question is, where can you actually go to trade, where this highly volatile environment, and where you realize that the fake volume, these fake numbers don't actually help you at all. And you actually realize there's only one or two trading venues that, when the markets are extremely high, that really show solid liquidity.
So it's clearly easier to manipulate smaller cap cryptos. Any tricks that are being deployed that might be considered illegal in more regulated markets?
Go ahead, Anton.
Yeah, so it's very, you know, first to say is there is no holistic regulation actually that mandates what's market, you know, surveillance when we're talking about crypto markets. So it's more like ways how to, you know, exchanges and the investors and traders that traded, they try to identify certain, you know, funny things that happen. But I'll give you an example that was always mind-blowing for me, is that I would see, you know, an exchange would have fees, you know, attached to it, and I would see a spread tighter than the fees, you know, and I was always wondering, like, who is there, you know, showing that tight spread, you know, if the fees eat up the profits from the spread, you know. And you can kind of see easily stuff like that, so you understand there are actually deals happening in the background that enable this kind of activity. And then you wonder, okay, who is this? If somebody has special terms, who is this special trader that has these amazing terms on a particular exchange? And many times is the prop desk of an exchange in the back that does this kind of thing. So I kind of explained here in a colloquial example. It's like, we don't really have market surveillance mandated. Then on the side, you see things that kind of don't make sense when trading happens. And then maybe you have conflict of interest actually, because there's a single counterparty actually doing too many things at the same time, you know? So I would say, the prudent way how to do it and how we approach it from an investment manager perspective is actually to do a very thorough due diligence on an exchange. Therefore, in the end, Flovtec trades at a very few exchanges because we would just not get ourselves involved with an exchange where, you know, they're the counterparty to all our transactions, you know. So it's really, I have to say it one word, it's like thorough due diligence when you ask the tough questions. And if the exchange cannot answer the tough questions, you just don't trade there. It's as simple as that, actually.
We have seen actually two scams. That one was basically the pump and dump of the Dogecoin, when basically a couple of weeks ago, a few weeks ago, some were trading that basically if everybody was basically buying a small portion of Dogecoin, the coin would jump. And this is basically what it did. But then the investors, or I should call them investors, basically the fools who played that game, were basically the one holding the bag when the initiator of the trade decided to sell. And so they were stuck with basically a declining price. So it's a classic pump and dump schema. What we have seen, I think it was early September, there's been a sort of flash crash, if you want. The Bitcoin that went down like 10 or 15%, and Ethereum went down 20% in just 5 minutes. And that could be definitely done when the markets are nearing a technical point, either a moving crossover of a moving average crossovers, or if you are crypto hitting resistance or very close to a breakout level. And then you can basically, if you have enough basically size to trade, you can build stealth position on a crypto. So you buy, and then when you have built a big enough position, you just buy some futures. So you sell some futures on that same position stealthily, so you won't be basically push the market downward. And then at some point when you are loaded on short futures, you just drop in a market order a big chunk of your coin in the spot market. That would basically put pressure on the order book, and so your order will basically hit all the ask. And in this case, sorry, the bids, and then you basically push down the market. But because you were short the futures, you are basically making money on the move that you was the one who triggered. You know what it was doing, and then you cover your shorts when you're at the end, and then basically you have basically made a nice profit by manipulating the market. This is totally illegal with traditional markets. As Anton said, there is no policy for crypto markets so far. And so it's still the wild, wild west in crypto trading. That used to be trading in the early 80s or before in the bucket shops. And basically we see right now in the crypto markets what the traditional assets were trading in the early 80s.
Anton, what about DeFi? Are you participating in any staking or secured lending?
Yeah. So first, to tell very honestly, I'm a huge fan of DeFi, and whatever, you know, a lot of the things that are happening in DeFi space is exactly how the world is going to look like 20 years ahead. Now, the problem with DeFi is when you're running a compliant and regulated entity is that, you know, we have to answer questions like how, you know, who is the counterparty? Can we do due diligence on them? You know, are they actually managing the assets? And when you take a closer look at DeFi, they're really built at the moment for retail. So people who really take risk with their own money, and usually not a lot of money, and then they're experimenting around it, you know. So I think it's a fascinating space, you know. We are not ready for it, you know, as a compliant and regulated, we cannot go there. It's just not the right time. But I will actually mention a couple of projects that for me, I think are mind-blowing. And when, you know, they improve a little bit or when they take the next step, we're definitely going to look close into it. One is Melonport, actually. So Melonport allows you to create a fund with the click of a button, you know. And David and I myself know how painful and expensive it is to set up a fund. So, I mean, what Melonport is doing is the future. And that's exactly how it's going to be. You know, you are going to show up, you'll say, I'm an asset manager, let me click a button and create a fund, and whoever wants to put in there, you know, they can put in the capital. It's going to be a regulated collective investment scheme, all great, you know, but we're going to get there. The other one for me, a mind-blowing project for a specific reason is actually Uniswap. And I will tell you why. Because Uniswap showed that you don't actually need an exchange. Because if you think about it, Uniswap is like a global market maker, you know? So this is mind-blowing because all of a sudden you realize all of these big exchanges that are the gatekeepers. So you're a project, you want to list your token, the exchange is the gatekeeper. they tell you if they will list you or not. But Uniswap works is like you just say, well, I put my token there. There are two pools, actually, that are going to be references actually how we're going to create a cross. In Uniswap, there is even a very simplistic way they enable exchange one asset from another. And it's mind-blowing for me to show actually that in the future you will have, hopefully, and that's why Flovtec exists, you will have actually market makers that will be, doing all of these trades and actually will not need an exchange actually, if I'm right about the future. So this is kind of things that are fascinating for me, but to be very honest, are regulated compliant and that they cannot easily enter this kind of opportunities. So mostly prop shops and people who risk their own money.
And David, what's keeping you up at night that hadn't kept you up in traditional markets?
I would say that what is really the known unknown in cryptos is really about regulation and what the governments can declare overnight as a new regulation. And let's say that if overnight large country decide that trading crypto is not legal anymore, or because they eventually made up their mind and that some cryptos are financial instruments and so they should be regulated as a traditional financial instruments, and that all asset managers have to comply the next 30 days, that would definitely be a nightmare on the whole industry, and lots of projects will basically go under because they don't have the resources to finance all the compliance. There are all the law firms and the legal teams are not really aware of what would have be needed to comply with. So that's really the biggest risk for me, is not in the market, because it is still a native and a young market, highly volatile, and so you take your risk, you know what you're doing. Especially in DeFi, as Anton said, that's really now basically the early beginning, and so you have to trade at your own risk. But this is really what could really throw a monkey wrench in the whole ecosystem right now, is a tighter regulation coming overnight, or almost overnight, I would say.
Anton?
So just want to say first, I definitely agree with David. There are a lot of risks, that we need to address actually to deploy capital in a safe and secure way. So I just want to, emphasize this is how important, and that's why we have sleepless nights, all of us. So, but I will play the devil's advocate here. And actually, if I have to say, is actually the biggest, worry for me would actually be if tomorrow all the regulators and governments say Bitcoin is the future and we're all going in, and tomorrow we have Goldman Sachs and JP Morgan competing against us and recreating the same mess they created in the traditional finance. That's why, the digital asset world exists, recreating the same thing in the digital asset world, and then all of a sudden we have to compete with all these huge players, and the world will look a lot different, from one day to the other, So if I have to explain it, I think that this young and very early stage where we are, it's a big opportunity for startups like Flovtec, like ExoAlpha and a lot of others. We can really recreate the financial infrastructure and the financial world in a very positive and future-oriented way. So I think that's a big opportunity, but there's risk, all of a sudden, actually, if everybody says this is the future, all of a sudden you're competing with huge entities, and we are small, poor startups, how are we going to compete with Goldman Sachs so easily, And maybe we have our own ideas how the future would look like, but they don't share the same views. Or the dream would be that we all actually agree and hold hands and say, we see a bright future and let's build everything in that direction. So I'm playing a bit of a devil's advocate here, but I think the early stage that we are now is a huge, huge opportunity for us, And the longer, the people are waiting on the sidelines, the better actually it is for the digital asset world and for all these amazing smart ideas like Melonport, like Uniswap, like Compound. I mean, they can experiment, do an amazing work, and something will come out of that will be, a foundation for the future of the financial world. So playing a little bit of devil's advocate here, and now going back to the risk that David said and say that, but we are where we are, and there's a lot of complexity if you want to actually be an investment manager and do it in a regulatory compliant way that, are keeping us up at night.
Well, great. Thank you both so much for being with us today. And we will have to have you back soon and see what transpires.
Yeah, thank you very much, Nisa.
You've been watching Coinscrum Markets. Thanks for joining us. See you again next week.